Today I'm going to go over 5 things that people get wrong about the infinite banking concept. I mean, it's quite simple. I've been doing this well over a decade, but you see, I started in the same place you would. I started using it. I didn't start teaching it. Actually, I had no desire to teach the infinite banking concept. All I wanted was to solve my problem. And at that time, my problem was I was in debt and I didn't want to be in debt anymore. Plus, I liked the idea that I could get all the money back for every single car that I ever buy, drive, and own. And I'm sure you're here for some of these reasons, but today, we've got to discuss what you and what so many other people get wrong about the infinite banking concept. So let's dive in. So, I mean, what could you get wrong about a simple banking concept? I mean, for real, what is the infinite banking concept anyway? It's just the process, notice I said process, of you taking back the banking functions in your life. So what are your banking functions? Well, first off, you make deposits into someone else's bank. When you want to buy something, you probably go to somebody else's bank and take a loan. And when you do that, are they paying you more in interest on your deposits than what they're charging you on the loan? That is where we need to really focus first. 7 minus 3. You all can do that in your head, right? Yeah, that is all we need to understand for this first section. Because if you can understand how to add and subtract, you can understand how banking works, because it is all about a spread. 7 minus 3, now let's just put some context to that. If the bank charged you 7 and paid you 3, how much is the bank making? There we go. So the very first thing we must understand is a thing called a spread. Because this is realistically one of the most important things when it comes to banking, just traditional banking. Let me explain. You make deposits into a bank account. Every single one of you watching this probably has a bank account, checking account, maybe a savings account, where you put your hard-earned money. And then the bank pays you interest on that, or at least I hope they are. So we're getting some form of interest. Now, the average is about 43 bips, okay? So not quite a percent, not even 0.5%, but I think some of you right now could be getting up to 4%. So that's essentially what the bank is giving you for leaving your money there, or how I like to say it, for you giving up control of your money to the bank. Because realistically, you think you're in control of that money, but you aren't. Because if you were in control of that money, when the bank went to make a loan from your money that you left there, so the bank makes a loan, if you were in control, the bank would have to pick the phone up, call you and say, hey, Mr. Client, hey, we're thinking about lending your money out on a lawnmower loan, and we were wondering if you're okay with that. Does the bank do that for you? No. Because when you opened your deposit account, you signed a piece of paper, literally giving them control. So what the bank does is the bank lends your money out in the form of credit cards, car loans, mortgages, and my crappy little lawnmower or tractor drawing. But when they do that, if they pay you, let's just come down here and pretend that all of you are getting 4%. Can you get a credit card for 4% interest? Or how about less? No. How about a car loan right now? Can you get a car loan for less than 4% right now? Probably not. Can you get a mortgage for less than 4%? Heck, no, they're more like 7% now. And can you get a lawnmower loan for like 4%? Probably not. So in other words, the bank is charging more on these loans than what they're paying you in interest. So therefore, they are profiting through a spread. But when that happens, the money that goes out, the bank is the recipient. So let's just put the bank in the middle. The bank is the recipient of these monthly payments, okay? So every one of these loans gives a monthly payment back to the bank. Principal and interest. And all they need to do is pay you what they told you they would pay you. However, the bank actually has another thing that they control. The bank can reduce that interest rate at any time. This isn't fixed. This is actually fairy tale land right now because we're in a high interest rate environment. Like I said, the average is less than 0.5%. So, what did the bank do? They made a spread. But what do you need to do? Well, what you need to do is change where all of those payments go. Remember, the payments today go back to the bank, helping them make a spread. But let's just replace bank with your bank. Sounds a lot better, right? So that every payment for the credit cards, the car payment, the mortgage, the lawnmower or tractor are all coming back into your account. So this would be called recapture, and that is what we're going to focus on. But if you were able to do that, would you not be the one making a spread? Would you not be the one taking control? So this is the first thing that we're going to talk about is your spread. In you taking back the banking functions and in you using the infinite banking concept, that is indeed what you are doing. So this is the fundamental basics. You are literally changing who the payments go to for everything in your life. Now, this doesn't happen overnight. Clearly, in order for this to happen, you would have to capitalize your banking system. So the very first thing we need to do is capitalize your banking system. No longer making deposits in their bank, but making deposits in your bank. So that probably leaves you a bit confused and perplexed, right? Chris, if I'm not making deposits in the bank account, like where am I putting the money? Well, let's move on to number 2, and that's what I'll cover. Before we do that, I'd love to ask all of you to do a little something for me, and that is click that subscribe button. And while you're clicking the subscribe button, what I'd also like you to do is right up above, pretty freaking awesome, right up above there is a little bell. Ding, ding, ding. That's right, I would like you to punch, actually just smash that bell. And that'll notify you every time I put new content out or do a live. Infinite banking concepts is nothing more than a process. That's all it is. It's a process of taking back the banking functions in your life. However, you need to run your money through an account. So wouldn't it make the most sense to run your money through the most efficient vehicle there is? Sure would. Let me show you what I'm talking about. All right, before you have a panic attack with all this stuff going on the board, I just want you to understand one fundamental thing here, is where are we going to put your money? Because if we can't use a traditional bank, because I already told you, when you use a traditional bank, their job is to make the spread. And we need to change that to now you making a spread. So there is only one way to do this, and it is the same way that the wealthiest families throughout history have done this. Those of the Rockefellers, the Rothschilds, the Morgans, the Stanleys, Ray Kroc, Walt Disney, Doris Christopher, and some of the sitting presidents throughout time have all used the same thing I'm about to tell you. And you know what it is? It is a specially designed and engineered whole life insurance policy from a mutually owned company that pays dividends. That is not what you were thinking I was going to say. So let me just go through and explain why we would use this specially designed and engineered whole life. And did you hear me say that? Specially designed and engineered? It is not a regular whole life. So please, before you get excited and run out to your advisor or your agent and say, hey, I got to get one of those whole life policies so I can become the bank. That's not going to work, because these, from a contractual level, need to be designed and, like I said, engineered to do this. Now, real quick, think about a car, right? Think about a Ford Focus. It's not a sexy car. You walk into a Ford dealership and you're looking at a Ford Focus. I mean, you're not sitting there thinking, I'm going to knock it out of the park. I'm going to drive this thing down. Guys and gals are going to be just staring at this thing. Nope, it's just a normal car. However, if you follow YouTube and the late Ken Block, he raced a Ford Focus. And that Ford Focus literally was insane. It had like 800 horsepower, would go sideways at 130 miles an hour in control. But what's the difference between Ken Block's Ford Focus and the one you saw at the dealership? It's simple. Design and engineering. That is the only difference. So therefore, that's what you need to focus on. This whole life that we're going to design is designed to be used for the infinite banking concept. But here is why we use it. First off, the contract for a whole life policy pays you a guaranteed interest rate. Now remember, we were talking about the bank and we were kind of joking around saying the bank's paying you 4%, but they can change that 4% at any time. You see, in the insurance policy, they're going to pay you a guaranteed interest, and that can be up to 3.25% as of today, and it is set forever. as long as you're alive, they're going to pay you a guaranteed interest rate, and it never changes contractually. So would you rather earn 3.25% for the rest of your life, or 4%, but then have it drop to 2 and then have the average be about 0.43%? Yeah, 3.25. But see, it gets better. Remember I mentioned they are mutually owned life insurance companies. So therefore, because they're mutually owned, they don't have stockholders to appease. They only have to appease the policyholders, you. And because of the nature of how these companies are set up, they pay a dividend. You know what that dividend is every year? It is a return of unused premiums that the insurance company collected. In other words, it's the profits. They return that back to who? You, the policyholder. So not only are you getting a guaranteed interest rate, but you're also getting dividends every year. And these dividends are not guaranteed. However, they have never missed a dividend payment. And the youngest of all the insurance companies we build these policies with is 143 years young, and they've never not paid a dividend. So if we wrap just the interest and the dividend up, what are we looking at? About 5.75 to 6.4% dividend crediting rate as of today. So unless you can find a better rate than that out there with a bank, get the guarantees that you can, and have the stability, well, then I think we found a better place. But you see, it gets even better, because that guaranteed interest and dividends inside the policy, if it's designed and engineered properly, grows tax-free. So you can't even get that return at a bank, but if you could, it's still taxed. Where here, it's a tax-free environment because it's considered life insurance. It's also protected against judgments and liens in most states, but not only that, it's private. So there's no reporting of this, so people don't know how much money you have. And lastly, it provides a death benefit. So in other words, you're protecting your family. So wrap all those things up with a little bow tie. Now you can see why the wealthiest families have used this vehicle for their banking functions. Now, because we're talking about an unconventional vehicle with being the whole life, it's important that you understand next, how do we take this vehicle, the specially designed whole life, and wrap it into a process called the infinite banking concepts and not make any mistakes? Let's dive in. This next one is single-handedly the most important one, and you'll do the most harm to your banking system if you don't follow this. Be an honest banker. Pay yourself back. You remember earlier when I was talking about borrowing money from a bank? So if you go to a traditional bank and you take a car loan out, and you get the loan, now you're driving the car around, every month you make payments back to the bank. Those payments include principal and interest. Now, let's just say we get rid of the bank and we pay that car loan off with our bank, which, remember, our bank is the capitalized whole life insurance policy from a mutually owned company. So now, when we take the loan from the whole life policy and pay off the car loan that you took from another bank, most people at this point would just say, all right, car loan's paid off. But if that's where you stop, then you are not being an honest banker, because you were making monthly payments every month to their bank. Now you paid their bank off using a loan from your bank. Now, when you take a loan from your bank, what should you do? You should make the same monthly payment at the same interest rate that you were paying their bank back to your bank. Think, it makes perfect logical sense. I mean, let's just put it this way. Let's just assume that you owned a bank. Literally, like at the end of your street, there is a bank that people go to make deposits, and it has your name on it. So this is your bank. You worked hard for this bank. You walk into your bank and you take out a loan from your bank. And you walk out the door. What would you probably do? Well, you'd probably make payments every month back to your bank, because you wouldn't steal from your bank. Because if you stole from your bank, your employees would watch this and they would start stealing from the bank. And then the customers, your clients, would watch your employees stealing from the bank, and then they would start stealing from the bank. You see, it's got a ripple effect. So therefore, if you owned a bank, you would make deposits in your bank. Yeah, why would you go across the street to Bank of America? You wouldn't. You own the bank. And if you owned the bank and you took a loan from your bank, you would make monthly payments back to your bank, would you not? Of course you would. And those monthly payments you would make back, wouldn't they be at the same rate you would have paid the bank across the street? More than likely. Maybe you shave off 0.5% or something. That's okay, because you're in control of the money, the rate, the duration. You control all of that because you own the bank. But you would never steal from your bank. This is the single biggest thing people do wrong with the infinite banking concept. And I don't know why. It's just we're not taught how to be an honest banker. Now, let me go back, and I just want to show you what I mean by that. Remember, we're going to capitalize our bank. Okay, so we're just going to write BYOB. So all you're doing is your savings that you make now into a traditional bank, we're just going to change where they go first, and we're going to put them into your bank, which is that policy. Then when we need money to do things like pay off credit cards, buy a car, pay off a car, buy a house, buy a lawnmower or a tractor, what you would do is you would take a loan from your bank or take a loan from your whole life policy. But I want you to think as if you're the bank. I am so used to doing this, I can't even think any other way. People are like, oh, you mean you took a loan from your whole life policy? I'm like, no, I took a loan from my private bank, which, yes, happens to be a whole life insurance policy. Now, here's the cool thing. When I take the loan from the insurance company, I'm not actually taking my money. It's kind of like a traditional bank. If you went to your bank and you took a loan from your bank, are you taking out your money or are you taking out some of everybody else's money? You're taking some of everybody else's money, right? Well, it's the same idea. When you take a loan from the insurance company is just giving you some of the money from their general account. That's why it's called a loan. And yes, they are charging you interest. Right now, it's anywhere between 5 and 7%, but better right in the middle, about 5.5% is the average. So why are they charging you interest? You're probably thinking, why would I pay interest to the insurance company when it's my money? Well, you would, because if you understood the first thing I said, spread, you would understand why. Because remember, the insurance company is paying you guaranteed interest plus dividends. And how much did I say that was? Let's use the lowest one, which is right now, as of today, a dividend crediting rate of 5.75%. Let's just do some math, and this is just an example, okay? This is not exactly how the math would work, but I just want you to understand this. If the insurance company paid you 5.75% on your money, and the insurance company loaned you your money at 5.5%, okay? We'll just use that. How much did you make? What was your spread? Well, it would be 0.25%. That would be your spread. So in other words, now you are doing the same thing that the bank was. Yes, you're not making as much, but you're still making the spread. But see, here's where it gets even better. I know you're probably not excited about 0.25%, which you should be actually, because most of you, or many of you I should say, are probably not even getting that on your bank account. But here's why this is important, so pay attention. The money that the insurance company has inside the whole life is called cash value. Your cash value is earning a dividend crediting rate, which is the interest plus the dividend, of 5.75. But when you take the loan, you didn't take your money. The insurance company gave you part of their general account money. Picking up what I'm putting down? That means that your money, your cash value is still in the policy earning uninterrupted compounding interest while you still got to use it and make a spread. So now what that means, if you understand mathematics, one is going up, which means this one, your cash value, is going up because it can go no other place. It's just math. Compounding interest. Look up what Albert Einstein said about compound interest. He said it was the eighth wonder of the world, the most powerful thing in the financial universe. He understood compounding interest, and you should too. So if your money is growing and you're paying interest to the insurance company at a rate that is simple interest, what happens the next year, the next year, the next year? Your spread goes up. It can do nothing else because you're compounding on a higher balance and you're paying interest on the exact same. But here's where it gets even better. Remember, back to what we said with the number 3. Be an honest banker. Pay yourself back. So now, whatever it is you use that loan for, let's just pick on, I don't know, we're going to pick on a tractor, okay? And let's say you could have gotten a loan from Bank of America for that lawn tractor for 7%. So how much are you going to pay your bank back? The exact same amount Bank of America is going to charge. But let's be fair. That's how I would do it. But some of you are like, no way, man, it's my bank. I want to pay my bank back less. Sure. You could charge 6.5%. You could charge 6%. You are in control of that. So, but now, if you're paying your bank back at a rate of 6.5% because you wanted a better rate than the competing banks, what's happening to this loan amount? It's going down. Because every monthly payment you make back to your bank is paying down the loan you took from the insurance company while your money's still compounding uninterrupted. So therefore, this interest rate of 5.5 is being charged on a declining balance. So you see, one is going up the other is going down, and because of that, your spread gets bigger and bigger and bigger the longer you do this. But it is essential that you recapture the money that you would have given away to other banks for the loans that they made to you. Because you are now the bank, you have to think as if you're the bank, and you have to treat your money the same as you treat their money. So you have your money in the specially designed whole life, and you're benefiting from your money growing in the policy with uninterrupted compounding interest, and you think you've made it. Wrong. I'm not saying all that isn't good, but you're still not doing the infinite banking concepts. Again, the infinite banking concepts is a process. By you putting money in the policy, that is just funding a product. Now we need to follow a process. You will never be wealthy if all you do is save money. Now that probably doesn't make sense to a lot of you, but there is no wealthy individual out there that just saves money. They put their money to work. They put it in motion, which is what you must do. The money goes in the policy, earns that guaranteed interest and dividends, but then, I already said this, you can then take a loan from the insurance company and send it out to work. But your money still earns uninterrupted compounding interest. So why would you ever just stop with just putting your money in the policy when you could earn the same interest rate and dividend if the money were out working? And the only thing you'd have to factor in is the cost of capital, which is the cost that the insurance company charges you on the loan, which today is less than what they pay you. So therefore, why would you just leave it there? Well, you shouldn't. You should put that money in motion. First thing, most people have credit cards, so we should pay the credit cards off. And then when we pay the credit cards, if you were paying $500 a month on credit cards, but now you paid them off with a loan from your bank, you should take that $500 that you were giving away, and then you should recapture that back into the policy. And you know what the cool part about this? If you were giving $500 away to the credit card, you couldn't just go get that $500 after you made the payment. No. That was the credit card company's money. But see, now you're the bank. So if you make a $500 payment back to your bank to repay your bank for the loan it took out to pay the credit cards, how much money is in your bank every single month in your policy? $500. Because you own the bank. You control the flow of money. So then what you do is you take the $500 plus the savings and you pay off the car loan, or you buy a new car. Then you pay off the mortgage, you pay off the tractor. Every one of these things had a payment. $700 for the car, $1,300 for the mortgage, maybe $200 for the tractor. Add all those up. I already said that in the beginning. How much are you giving away? Well, no more. Your money remains in motion, and every single payment then just keeps coming back here. The $700, the $1,300, the $200 gets recaptured back into the policy, creating another problem. You are now out of debt. You have no debt. You paid it all off. The only debt you have is back to your bank, but it's your bank. So now you're psyched, but now what you got to do is you got to find other things to invest in, like making private loans, just like a bank, lending money on real estate, lending money on cars, whatever. Heck, Turo. I've done videos on Turo, like buy a car and Turo it out there. You can do anything, which is why it's called infinite banking concepts. So you see what's happening here. Just like a bank, your money is in motion, but your money's in motion, and at the same time, it never stops compounding. So a lot of people get their policy and they get excited, and as time goes by, that excitement fades. Life gets in the way, people feed into them, and they start to conform with their old habits, their old ways of thinking about money, and they stop performing the process called the infinite banking concept. And in this next part, you're going to find how important it is to keep expanding your banking system, your family bank. Let me ask you this. When you drive around your town, your city, or wherever you live, do you just see one bank office? Like, is there just one branch? No. Chances are you could go one block down and find another branch, another block down to the right, and another branch. Banks are constantly opening branch offices. So just like the traditional banks where they keep expanding and opening branch offices, you don't really have to open branch offices, but what you're going to want to do is keep putting more and more money into your banking system. But here's the problem. You can't do that with one policy. Because when the policy is designed and engineered, it's designed and engineered around your particular goal for saving at that time. You might start off like I did, really small. I started my first policy with about $240 a month because that's all I could save. But now I put hundreds of thousands of dollars every single year into my policies. But I don't just have one, I have 14 plus policies on my daughter, plus policies on my wife. Do you see, I have expanded my banking system, and you would do the same. So once you kind of get used to doing this and you start following these 5 steps, or the 5 things that people do wrong, you don't do them wrong, what you're gonna have to do is start expanding your banking operation. And by expanding your banking operation, that means opening additional policies to hold more capital, to hold more of the money that you have now taken control of. Now, I'm not gonna go too deep into this, but this is the final thing people do wrong. They start, they have success, but they stop at 1. You don't want to do that because you have just restricted how much your banking system can do and how many things your banking system can finance. Because if the whole point of the infinite banking concept is for you to take back control of your money and for you to take back control of the banking functions in your life, you must continue to expand your banking system. And if you like this video, check this one out. It's going to tell you everything you need to know about the infinite banking concept. We'll see you next time.